What if a single decision by India, a country of 1.4 billion people and the world's third largest oil importer, sent global oil prices soaring to an unprecedented $200 per barrel? What if this decision didn't just impact India, but triggered a cascade of inflation, economic instability, and geopolitical realignments across the world? Today, we unravel the complexities of India's Russian oil imports, a trade relationship that's more than just commerce. It's a lifeline for India's growth and a strategic lever in global power politics. From shipping lanes to diplomatic corridors, this story reveals how energy, economics, and politics are deeply intertwined. Let's break down the numbers that highlight this seismic shift. Prior to the Russia-Ukraine conflict's escalation in 2022, Indian imports of Russian crude were negligible, just 0.2% of its total oil needs. Fast forward to 2025, Russia now supplies between 35 to 40% of India's oil demand, approximately 1.8 million barrels daily, peaking at over 2.15 million barrels in mid-2023. This surge represents a staggering 20,000% increase in just a few years, reflecting India's strategic pivot amid global sanctions and market disruptions. Why? The initial driver was the steep discounts Russians offered, up to $42 less per barrel compared to global prices, a significant cut given crude's volatility. Though these discounts have shrunk to a range of $2 to $5 per barrel today, Indian refiners continue purchasing Russian crude. This continuity underscores not only economic incentives, but also India's quest for long-term energy security amid uncertain global supply. What if India abruptly stops buying Russian oil? The immediate financial blow is immense. Estimates show an additional $9 to $12 billion. Annual spending would be required to source alternatives. To put that into perspective, this amount is roughly the entire annual budget of ISRO, India's space agency, multiplied by nearly 9. It's the budget that propelled India's Mars orbiter mission and ambitious lunar programs. But financial cost is just the surface. Higher oil prices translate directly to costlier petrol and diesel, driving inflation in transportation, agriculture, manufacturing, and everyday goods. With 1.4 billion people, most of whom rely heavily on affordable energy, this cost hike inflicts widespread economic strain, especially on the lower and middle classes. Additionally, India's refineries have become key global processors of Russian crude, refining and exporting petroleum products to markets like Europe. Halting these operations disrupts global refining capacity, creating supply shortages and price shocks beyond India's borders. The nightmare scenario: oil prices surge to $200 per barrel. Why? Russia exports about 5 million barrels each day globally, with India and China consuming a combined 85%. India's sudden exit leaves roughly 2 million barrels needing new buyers immediately, a logistical and economic challenge. Oil markets are extremely sensitive to supply disruptions and sentiment. Rumors or announcements alone can trigger panic buying and speculative hoarding, sending prices soaring. Recall 2008, when oil prices hit $147 a barrel, equivalent to roughly $190 today, precipitating the global financial crisis. If oil hits $200, sectors like aviation would ground fleets, shipping costs would explode, and manufacturing would grind to a halt. Food prices would skyrocket as transportation becomes prohibitively expensive, particularly devastating developing nations dependent on imports. Economic models predict a sharp global GDP contraction and inflation rates not seen in decades, turning the 2008 crisis into a minor blip by comparison. Donald Trump's government has aggressively targeted India's Russian oil imports by slapping a 50% tariff on $87 billion worth of Indian goods, an unprecedented economic weapon designed to punish India for supporting Russia's economy. The tariff affects diverse sectors, including textiles, automotive parts, and pharmaceuticals, magnifying pressure on India's export-driven economy. In response, major Indian oil firms such as Indian Oil Corporation, Bharat Petroleum, and Hindustan Petroleum have halted new Russian oil purchases from spot markets, pending clearer government direction. Despite this, Indian officials publicly condemn the tariffs as unjustified and unreasonable, affirming their commitment to energy sovereignty. Simultaneously, India diversifies by purchasing crude from Nigeria, Angola, Abu Dhabi, and the United States, signaling a tactical hedge against escalating geopolitical risk. This strategic maneuvering reflects India's determination to balance economic imperatives against external pressures. This conflict is not just about oil, but marks a pivotal transformation in global geopolitics. India deftly balances its relationship with the U.S., its partner in countering China, while maintaining energy ties with Russia and competing with China for regional influence. This strategic autonomy signals the emerging multipolar world where middle powers reject being pawns in superpower rivalries. India's surging population and booming economy fuel an expected increase in oil demand by an additional 1 million barrels daily by 2030, making energy security critical. For Russia, India represents a vital economic lifeline, offsetting losses from economic sanctions and sanctions that have largely closed European markets. Russia's innovative adaptations include a shadow fleet of tankers operating outside traditional channels and payments in rupees and yuan instead of dollars. This erodes the US dollar's hegemony while fostering an alternative financial architecture, highlighting a fundamental shift in global economic power. The future could unfold in multiple ways. Scenario 1: gradual decoupling. India slowly reduces reliance on Russian oil while increasing imports from the Middle East, Africa, and the Americas. This methodical approach cushions market shocks, but costs India billions annually in higher prices. Scenario 2: abrupt cutoff. Under extreme external pressure, India halts Russian imports rapidly, potentially triggering the catastrophic $200 barrel spike, a global recession, and unintended damage even to the US economy. Scenario 3: strategic defiance. India maintains Russian imports while absorbing tariffs, risking a protracted diplomatic standoff. This tests the limits of American influence and Indian resolve. Current trends suggest a gradual approach, but unpredictable variables. China's alignment, OPEC's output, or Middle East unrest could escalate risks, pushing the world toward more dire outcomes. This episode is a microcosm of wider global shifts. India's decisions weigh heavily on worldwide oil prices, inflation, and economic health. Middle powers like India are distancing themselves from unipolar dominance, forging independent paths. Paradoxically, this crisis could accelerate renewable energy adoption, making alternatives like electric vehicles and solar power more viable. Yet, short-term volatility and rising geopolitical tensions are unavoidable. The global economy hangs in a fragile balance, shaped by decisions in New Delhi, Washington, and Moscow. The stakes are immense, determining the course of prosperity or hardship for billions. Stay with us as this story unfolds. And now, we want to hear from you. Should India prioritize energy security or acquiesce to international pressure? Share your perspective below and subscribe to Elite Archives for more in-depth analyses of crucial global issues.